Have you ever wondered if there's a strategy to mitigate the risk of investing in volatile markets? Let's dive into the concept of dollar-cost averaging. This is a strategy where you invest a fixed amount consistently in a particular asset. And here's the kicker. You do it regardless of the asset's price fluctuation. Imagine a roller coaster ride, but you're not fazed by the ups and downs. You're calmly enjoying the ride, knowing you have a strategy in place. This method is especially useful in volatile markets. Instead of trying to time the market and predict the best moment to invest, you spread your investments over time. This approach reduces the risk of investing a large amount at an unfavorable time. It's like putting on a safety harness before the roller coaster ride. So, the key takeaway here is that dollar-cost averaging is a disciplined saving method that can help you navigate volatile markets. Now that you have a basic understanding of dollar-cost averaging, what do you think are its benefits? Let's dive right in. One of the most significant advantages of dollar-cost averaging is that it mitigates timing risk. We all know that predicting the perfect time to invest in volatile markets like cryptocurrencies can feel like trying to catch a falling knife. Dollar-cost averaging reduces this risk by spreading out your investments over time. This way, you're less likely to invest a large amount at an unfavorable moment. Investing consistently over time, regardless of price, can average out the cost per share of your investment. Next, let's talk about emotional detachment. Investing can often feel like a roller coaster ride with all the ups and downs of market fluctuations. It's easy to get carried away by emotions and make rash decisions. However, by automating your investments with dollar-cost averaging, you can detach yourself from these short-term market swings. This detachment allows you to stay the course and keep your eyes on your long-term financial goals. Now, on to disciplined saving. Dollar-cost averaging is more than just an investment strategy, it's a habit. It encourages regular and consistent investing, which is a fantastic way to build long-term wealth. Think of it as a form of forced savings where you continually contribute to your investment account, regardless of market conditions. Lastly, we can't overlook the simplicity of dollar-cost averaging. It's straightforward, easy to understand, and easy to implement. This makes it an excellent strategy for beginners or those who prefer a hands-off approach to investing. It doesn't require you to constantly monitor the market or make complex decisions. You just set it, forget it, and let your money work for you over time. Before we move on, if you're finding this information valuable, don't forget to hit the like button and subscribe for more insightful content. Therefore, dollar-cost averaging is not just a strategy, it's a way to bring discipline, simplicity, and emotional detachment to your investment journey. So, are you ready to start your dollar-cost averaging adventure? Given the high volatility of cryptocurrencies, do you think dollar-cost averaging is a viable strategy for investing in Bitcoin or other cryptocurrencies? Let's delve into this. Cryptocurrencies, like Bitcoin, are renowned for their dramatic price swings, which can be both a boon and a bane for investors. On one hand, the potential for high returns is enticing, but on the other, the risk of significant loss is a constant concern. This is where dollar-cost averaging can come in handy. Dollar-cost averaging is a strategy that can be applied to any investment, but proves particularly useful in markets known for their volatility, like cryptocurrencies. By spreading out investments over time, we can potentially reduce the impact of price volatility. Imagine this scenario. You decide to invest in Bitcoin, but instead of investing a lump sum, you spread your investment over several months. If Bitcoin's price is high one month and low the next, your average purchase price over these 2 months could be more favorable than if you'd made a lump sum investment at the peak. In other words, you're mitigating timing risk. It's notoriously difficult to predict the best time to invest in volatile markets. Dollar-cost averaging reduces the risk of investing a large amount at an inopportune time. Moreover, this strategy encourages disciplined saving and creates an emotional detachment. By automating the investment process, you're less likely to make emotionally driven decisions based on short-term market fluctuations. This can turn investing into a regular saving habit, which can be particularly beneficial for long-term wealth accumulation. Best of all, dollar-cost averaging is simple to understand and implement, making it an accessible strategy for beginners and those who prefer a hands-off investment approach. So if you're thinking of entering the crypto market, take a moment to consider dollar-cost averaging. And hey, if you're finding this information useful, don't forget to give this video a like and hit that subscribe button for more insightful content. As you can see, dollar cost averaging can be an attractive strategy for investors looking to enter the volatile crypto market. Having understood the concept and advantages of dollar cost averaging, do you think it's always the best strategy for investing? This question brings us to a point of debate. While dollar cost averaging is simple, mitigates timing risk, and encourages disciplined saving, it may not be the best strategy in all scenarios. Consider a consistently rising market, for instance. If you are consistently investing smaller amounts over time, you might miss out on the potential gains from investing a larger amount up front. Also, individual financial goals, risk tolerance, and market conditions play a significant role in deciding the right strategy. Remember, investing isn't about finding a one-size-fits-all solution. It's about finding a strategy that suits your unique circumstances and goals. So, while dollar cost averaging has its advantages, it's not a one-size-fits-all strategy. Would you consider using dollar cost averaging in your investment strategy, or do you think there might be a better approach?